Hello everyone. So today I want to do an explanation on how I took this trade on gold during the FOMC time. Uh, this trade, and then these are the results of the trade. So I want to do some explanations. This one. How did I capture all this? Sniper entry up to this point. I think at this time being, the trade has already hit the target. So then this one was my trade from my MetaTrader. This was my trade. Let me show you real quick. This was my trade for MetaTrader. So I took the trade at this point. Then this was our target. The price came up to this area, then bounced a little bit before proceeding to the downside. So I'm expecting more further drop after a pullback that will be created around this area. So let's see how I took this trade exactly from this was our area of doing consideration. First thing first, our weekly was our area of consideration. At the point of interest, we use the weekly time frame formation. We didn't use monthly. We have two time frame formation. We have the monthly and we have the weekly. So I used weekly. My students know that. Thereafter, this was our area of liquidity, or we call it the point of interest, where the price bounced around this area to the downside as well. We took this entry. I will be showing you. We took this entry here from this top here, but we were looking for some continuation. I think after price closing below here down, we'll validate the trend now. After price closing below this low, we'll validate the trend. This area is called the invalidation. So once price close weekly down here, then by next week, we'll still have some downfalls of the price. So thereafter, our 4 was our area where we wanted to enter the market. So we had this structure here, series of highs and lows. Thereafter, the market broke our structure. So this is the break of structure, or we call it a shift. This is the market shift that occurred in the market here. This is the shift. So obvious, price will target the structures inside this area, and which is this one. This was the structure that was targeted by the price until we got this nice sniper entry. So I also consider this area as for my entry for the price. So this was to be we call it area of liquidity. This is an area of liquidity that I considered for my price to take my trade before FOMC and after FOMC. So I will go down to 30 minutes time frame to look for an entry around this area. So our entry would be this area here. This will be our entry, but as you can see, the risk is too much. 26 pips. Can't use 26 pips on our entry. That's too much. Unless we wait for the price to reach that area, then to make another shift. So this will be we'll go down deeper to 5 minutes and refine our entry. So this would be our entry, and the risk here I think was only 11 pips. 11, I mean, let me put it well. It says 16, but it was less than 16 pips because I calculated the pips from the, okay, it was something like 11 or 10 pips from this area, only such amount of pips. So this would be our entry. Now this will be considered as our entry in the market. So in case we risk only less than 10 pips around this area. So let me play out. So as you go to our shift, this will be our entry. And where do we set our targets? Our first target, set it at, our first target, set it down below here. We call it first troubled area. I think it's down below here. This we call it a first troubled area. So we'll be having, no, wait, not this area. We'll have an area here. Okay, this area. This was to be our first target of 356 pips to be taken when the trade reaches this area. This is called our first troubled area. It's an area that it hasn't been touched by any price. So our second target maybe will be at this area. So why did I consider? Why did I consider this area? Because when we had this news release, first of all, we had another structure here. We call it a shift that the market broke. Then we had this minor structure, call it an outside formation. Thereafter, we had price coming inside this area so that it can go and take some liquidity up to this area after bouncing to this area down to the top. So we all trade these fundamentals based on technical. We don't look at the price data. Okay, what was the price data? So for those who, let's say they sold, for those who they sold, you saw the market doing some whipsaw. It came first to the downside, then proceeded to the upside, then to the downfall. And this is how you are taken out as the liquidity. And for those who were wise, they considered these areas for their entries. So let's play out and see how the market did exactly. So first of all, you see this movement here. This was the movement, the news release. Thereafter, we had a push to the upside. Then a down. As you see now, this candlestick came and closed down here because it came just for liquidity around this area. And when price goes for liquidity, it won't even blink. It won't take even a minute for it to fall down. Just a few minutes, then we are good to go. We are good to call it a day. Let me show you on how. What happened? What really happened around this area? So you see all this candle. So we had this high area of liquidity for the price came and rejected around this area, then proceeded to the upside to take some liquidity, then falls. That's why we're given this kind of candlestick, an imbalanced candlestick. So we had buyers and sellers. All buyers were rejected. So we had buyers for those who bought, and the price came and took for those who sold. I mean, took the stop losses for buyers again, took the stop losses for sellers, but the light entry was at this point. You might be correct, but we might not be, we call it, we need some accuracy in the market. and that's it. And that's how the market targeted our area, and now we are celebrating some 350 pips. So this is how we trade. Same applies to for those who wanted to trade. Those who wanted to trade this candlestick on US 30. It was a very easy trade, but um I only considered gold. You know, gold and US 30, they move on the same direction. They move on the same direction. So same applies here. We had our inside formation, then the price targeted our inside formation after the shift. Therefore, this was to be our point of interest for us to take the trade. I'll show you why and why was my entry. So this was to be, man, okay, we go down to 1 hour, look for our entries around this area. So my entry was at this point. This was my entry. Now maybe I should risk only 10 points on US 30 because it's too volatile. Because I can't see anything that will guide me here to put, okay, let me go maybe to 15 minutes and see. I need just to see the candlestick that block around this area so that I can put my stop losses in a very right place. Don't want to risk that much. Okay, this one. This will be my stop loss. So we'll go back to 1 hour. So entry stop loss, we'll go back to daily and set our targets. This is 5 points, maybe six point something points. So it will be very enough for you to enter the trade. I mean, for you to risk the trade. 60 is almost 60 pips for your start. Okay, it looks like our trade was to be missed. Let me align well these candlesticks. So once you don't put well yeah. So it looks like the trade was to be missed as well. So we missed the entry by few. See, trade, I mean, it was missed. I only 2 points. Let me check it well. Yeah, looks like. So you're supposed to be very active on this trade. So when your target becomes at this point, this is called first trouble there. You're supposed to be very active. Oh, it wasn't missed. I thought it was missed. So someone was supposed to be very active here on the trade. Okay. I thought it was missed, but it wasn't. So you risk 10 pips and now the trade is running. I mean, 6 points, and now the trade is running. For you start, it's too volatile. It's running 10,000. I mean, it went up to 944 points. So which means this is almost 9,000 pips. It's a normal thing for your starting. It's a normal thing for your start. So this was my entry. It was supposed to be your entry, and this was your target for the price. And this is how we took our trade.